Hello, my name is Alexander Warstler, and I'm in charge of the domestic healthcare sector of the AIM portfolio. Today, I'm going to pitch to you Harvard Biosciences, ticker HBIO. I'd first like to get into how my screening process for this. I really wanted to target the CRO market, so the contract research organization market. And to do that, the valuations of a lot of these companies were pretty high. And so I found Harvard Bioscience as a company that actually supplies a lot of the equipment to these CROs and academic research centers. And the company had been very beaten up compared to its peers on a enterprise value to revenue and enterprise value to EBITDA and a bunch of other financial metrics, as well as they had just got a new management team. And that's what led me to pitching HBIO today. Harvard Bioscience is a leading developer, manufacturer, and seller of technologies, products, and services that enable fundamental research, discovery, and preclinical testing for drug development. HBIO operates through two main segments: cellular and molecular technologies, which represents 63% of their fiscal year 2019 revenues, and preclinical products, which represents approximately 37% of sales. The cellular and molecular technology segment offers products designed to support the discovery phase of new drug development. The preclinical products segment provides services for monitoring physiological parameters of animal models used in biomedical research. Harvard Bioscience was founded in 1901 and is headquartered in Holliston, Massachusetts. HBIO completed their IPO in 2000 and have since grown to be a dominating force in the preclinical testing technologies industry. Harvard Biosciences has successfully completed 20 acquisitions, introduced over 50 new products to market, and serves customers in over 100 countries worldwide. Prior to Jim Green taking over as CEO in July of 2019, Harvard Biosciences' underlying assets have been poorly managed, which resulted in a 5-year CAGR of 1.3%. Contributing to this burden was Harvard Biosciences' 2018 acquisition of Data Science International, which was for approximately $71 million. As a result of the transaction, HBIO took on $66 million in debt. So that levered their balance sheet pretty heavily, and the stock actually did really well following the announcement of the acquisition. But after investors kind of realized that debt would be a little bit of a burden to the company when they weren't driving enough sales growth, the stock has been significantly undervalued after that acquisition. In September of 2019, Green announced a strategic action plan focused on paying down debt and reducing HBIO's leverage ratio to 3 times by the end of 2020, refinancing their debt to reduce the interest expense, rationalizing their product portfolio to focus on higher margin growth products, and optimizing the supply chain capabilities, which should all improve and have already improved gross margins to date as of Q2 of 2020. To date, the company is on track or has will complete all of these goals by year end. Under Green's leadership, gross margins have increased from 51.2% to 59.4% in Q2 of 2020. Adjusted operating margins over the same time period have improved from 11.2% to 17.7%. Moving forward beyond 2020, Harvard Biosciences sees an opportunity to leverage their expertise in telemetry systems to drive consumable and implantable device sales, expand their electroporation and CRISPR product lines, and create products that aid researchers in detecting antibodies. In addition, the company is well positioned to speed up their paydown of debt and continue their add-on acquisition strategy to accelerate top-line growth. HBIO's management team recognizes the growth trajectory of the CRO and pharma markets in the coming years and sees an opportunity to continue to introduce new products and service innovations to expand their total addressable market. With leading products and services, expanding gross margins and operating margins, new product introductions, and increased penetration in growing markets, it is recommended that Harvard Bioscience be added to the AIM Equity Fund with a price target of $5.76, representing a potential upside of 91.29%. The first driver is the contract research organization industry tailwinds. The CRO industry is poised to grow from its current market value of $48 billion to $74 billion by 2025, growing at a 5-year CAGR of 9.1%. Market growth is attributed to the increased outsourcing of early-phase clinical and laboratory testing services by pharmaceutical companies to boost profit margins, avoid high capital expenditures, and reduce the duration to validate their product. HBIO continues to be in a unique position to capitalize on this secular trend due to the company's ability to support the complete preclinical life cycle. So therefore, all of their customers can come to them for all of their preclinical products because they have consumables, equipment, and the technology to integrate all of the data that's being collected. So yeah, HBIO's consumables and equipments enable the collection of vast amounts of data, while HBIO's software systems analyze the collected data and produce research findings in the visual form. The second main driver is product rationalization and new product introductions. Since Jim Green took over as CEO in July of 2019, he has been trimming the tail of HBIO's product portfolio to focus exclusively on higher margin products in strategic areas of the life sciences industry. Previously, they had been really focused on the academic markets and have found that that's not a particularly strong growth-driving industry, whereas if we look at past CROs such as MedPace and others, those are growing extremely fast. And so Harvard Biosciences wants to trim their tail on their products, make sure that their capital structure is in line, and go after these larger markets. To date, HBIO's gross margin has increased from 51.2% in Q2 of 2019 to 59.4% in Q2 of 2020. Product rationalization will continue until the end of 2020 with a 65% run rate gross margin target. In addition, HBIO has executed focused efforts on introducing new products to support their customers' needs, as well as their continued growth. Last quarter, HBIO introduced a new inhalation product that provides researchers with real-time aerosol amounts inhaled and deposited in the subject's lungs. This product introduction comes at a pivotal time to support COVID-19 research and has already seen strong order activity and backlog. Going forward, HBIO sees an opportunity to leverage their expertise in telemetry systems to drive consumable and implantable device sales, expanding their electroporation and CRISPR product line, and create products that aid researchers in detecting antibodies. The third driver is big pharma expansion. According to IQVIA, the world's largest CRO, global pharmaceutical R&D spending is poised to grow from its current annual investment of $186 billion to $230 billion by 2026, growing at a CAGR of 3.6%. In 2018, HBIO acquired Data Science International to expand their presence in large pharmaceutical and biotechnology companies such as Novartis, Abivax, Sanofi, AstraZeneca, and Pfizer. The acquisition provides an opportunity for HBIO to cross-sell their telemetry systems, consumables, and instruments while also expanding their DSI customer base. As of Q2 2020, 63% of HBIO's revenue comes from large academic research labs, whereas only 37% comes from big pharma and CROs. HBIO is focused on further penetrating the CRO and big pharma customer segments. In order to reach an intrinsic value for HBIO, a 5-year DCF model was constructed using a terminal growth rate of 2% and a WACC of 7.61%, an intrinsic value of $6.44 was reached. A sensitivity analysis on the terminal growth rate and WACC with a plus or minus 50 basis points ranged from $5.74 to $7.43. Additionally, an EV to revenue multiple valuation was calculated using a blended average 2020 estimated enterprise value to revenue multiple of 3.35 times, resulting in an intrinsic value of $5.96. Finally, an enterprise value to EBITDA multiple valuation was calculated using a blended average 2021 estimated enterprise value to EBITDA multiple of 16.16 times, resulting in an intrinsic value of $5.09. By weighing the three models 30, 30, 40, a price target of $5.76 was reached, resulting in a 91.29% potential upside. HBIO does not pay a dividend. In terms of the risks, the first risk is the reductions in research budgets or government funding. Harvard Biosciences could be negatively impacted if the National Institute of Health reduces funding levels to government research labs, private foundations, or other institutions. The second risk is they operate in a highly competitive industry. And if HBIO's competitors adapt more effectively to technological changes, Harvard Biosciences may be adversely affected. And the third risk is their debt load. Harvard Bioscience has a debt balance of $41 million as of August 5th, 2020. Any failure to meet their debt obligations or maintain compliance with covenants could harm the business. James Green was named CEO in July 2019 and has been in the chairman role of the board of directors since June of 2017. Prior to joining Harvard Biosciences, Green served as the CEO of Analogic. Under his leadership, the company grew core revenues 50% and gross margins, operating margins, and earnings per share dramatically improved. Michael Rossi joined HBIO in July of 2019 and is a CFO. Prior to joining HBIO, Rossi was the CFO of Laboratory Medical Technologies. In closing, Harvard Bioscience represents a very unique opportunity in which I believe the AIM Equity Fund should capitalize on. Harvard Bioscience will continue to execute on their restructuring initiatives to position the company for long-term profitable growth. And when you look at when I completed the model, one of the things that really stuck out to me, and when I was looking at the estimates on FactSet, is the company has a very good operating structure in that they create a lot of cash flow from operations. Even before Jim Green took over in 2019, the company was generating approximately $9 million of cash flow from operations. And that number, as they grow revenues, is going to exponentially increase now that we've seen that Jim has been able to rationalize their product portfolio and drive those gross margins from the 52% range now into that 60% range plus with a 65% run rate. And so going forward, as they start to gain traction on the revenue side, and that drops down to the bottom line, investors are going to realize that this company is worth a lot more than the intrinsic value trading on the public stock markets today. Thank you, and I'll be looking forward to Friday's AIM call and your discussion posts. Thanks, and